Hi, I'm Kristen King, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. This week we're asking, after their post-election gains, are U.S. equity indices looking overvalued? Now, despite the uncertainty surrounding the election outcome, U.S. equities have risen sharply, led by the technology stocks. Equities had a further push to all-time highs on Tuesday on news that Pfizer had developed a COVID-19 vaccine, followed by a similar headline from Novavax and a strong suggestion by Anthony Fauci that Moderna is on the verge of a breakthrough too. Democrat leaders dampened the initial euphoria a bit, noting that we are still months away from actual deployment. When translated into real terms, this realistically means continued restrictions on business and day-to-day life. Furthermore, while the world has embraced Joe Biden as president-elect, market watchers can't help but notice that things aren't quite over the line just yet. Also, Republican gains in Congress raise the prospect of gridlock on Capitol Hill. So, when you combine a vaccine breakthrough with political gridlock, realistically, the prospect of a stimulus package reduces. As a result, investors are asking themselves whether rising valuations for U.S. equities are justified. The weight of money and the prevailing price action suggests the answer to that is yes, but are there other indicators that we can look to make our own assessment? Indeed there are. We can look at a couple of alternative valuation measures to help us make up our minds. The first of these is the CAPE ratio, which was developed by Professor Robert Shiller, a leading economist and thinker at Yale. The CAPE ratio, or the cyclically adjusted price-earnings ratio, is an inflation-adjusted price-earnings measure which excludes the influence of economic cycles. The ratio is calculated by taking a stock's price and dividing that by the average of its inflation-adjusted earnings over the last 10 years. Fans of the CAPE ratio believe that it provides a cleaner and clearer measure of equity valuation than the traditional PE ratio. The CAPE ratio can be applied to individual stocks or an entire index, and in this chart, we can see the ratio for the S&P 500 index. The current CAPE ratio for the index is 32.28 times earnings, up sharply from the year-to-date low of 24.82 recorded in the March sell-off. The S&P is at a higher CAPE ratio than it was when it posted its previous all-time highs in September, but is still below the peak of 33.81 times earnings that it reached in January 2018. Big tech has been a major driver of U.S. equity valuations this year, and the performance of a handful of trillion-dollar companies can distort the true returns of a market cap-weighted index like the S&P 500. In reality, the largest companies have the biggest influence on the index's value. One way we can try to look through that trait is to examine the performance of the S&P 500 compared to an equal-weighted version of itself, where every constituent exerts the same influence on index performance, be it up or down. Year-to-date, S&P data shows us that the equal weight index fell 2.84%, while the market cap-weighted version returned 6.58%, a figure 3 times higher. Most of the outperformance can be laid at the door of technology giants. If we look at the valuation of FANG stocks, we find that they finished October on a 12-month forward PE ratio of 57 times earnings compared to just 21.7 times for the S&P 500 index. That figure drops to 19.8 times if we exclude the FANG names completely. We started today by asking if U.S. equities were overvalued following recent gains in the current climate. The answer seems to be no when we look at the market as a whole. However, a key section of the market may be flying too close to the sun. But for now, a melt up rather than melt down in tech stocks seems more likely. That's all we have time for today, folks. As always, make sure you do your own due diligence before making any investment decisions.